Hi, this is Mike Maloney, and I've got a cold today, so my voice might sound a little bit raspy. I wanted to show you a presentation that nobody has seen since 2012. I gave this presentation in London at an event that we put on with Max Kaiser. And I just wanted to show you, every time I present something about the trade war, I get a whole lot of blowback from it. A lot of people writing in saying why I'm wrong, but nobody comes back at me with math. If you're going to complain or tell me I'm wrong, show me some evidence. Trade wars slow down world trade. It's just bad for the global GDP, period. So I wanted to show you some economics behind it, how trade flows work, and how our trade deficit, China's trade surplus with the United States, helps to fund our budget deficit. And without the trade deficit, it becomes much harder to fund the budget deficit. Now, right now, the current administration wants to be able to expand the deficit. They want to be able to spend more. So hang in there with me. I think you're going to like this. So here's China and the U.S., and China has all these factories. Walmart sells a cell phone to a U.S. customer. The U.S. customer gives Walmart dollars. Those dollars get sent over to China to buy a replacement cell phone for because they have to restock. And then those dollars get deposited in the businessman's account at the bank. Now, what's supposed to happen is the bank is supposed to exchange those dollars for yuan. They're supposed to sell the dollars on the forex, the foreign currency exchange, and buy yuan. But they don't do that because if they do that, the yuan, there's a shortage of yuan on the forex and a glut of dollars on the forex, and that causes the dollar to go down and the yuan to go up, so the exchange rates change. Chinese goods then become expensive in the United States and trade goes back into balance. That's the way the free market is supposed to work. Now, for years, China has manipulated their currency. And what they do is the People's Bank of China will buy the excess dollars, and then they'll just print up yuan, and they'll send those yuan to the businessman's bank account, but they'll take the excess dollars and loan them back to the United States so that they get an interest-bearing bond. There was just a report last month that the average interest they were making was 3.9 something or 3 something percent over the last 5 years. So they're making an interest income on the bonds, but when they buy those bonds, they're buying them with the dollars that we used to buy the cheap stuff that they produced. So they loan them back to us. It's a very large portion of our budget deficit. For a while, China had $4 trillion in currency reserves. Now they've got about $3.1 trillion in currency reserves. We'll get to that later. But basically, the trade imbalance, the surplus of trade that they have, that creates a lot of jobs in China, but it also funds the budget deficit that we run, and it creates cheap goods because this repeats over and over again. And what you see is that there's a buildup of yuan in circulation in China. The dollars that we're not printing brand new dollars, we're borrowing these same dollars back from the Chinese government to run our budget deficits. But the yuan in circulation in China expands, and so that causes raging inflation in China. And inflation is basically a form of tax. It's a hidden tax. And so the Chinese citizens are being taxed to subsidize goods that are sold to us artificially cheaply because they've manipulated their currency. So we get lots of cheap stuff, and then they take those same dollars that we bought that cheap stuff with and they loan them back to us to run the budget deficit. It's a very large percent of our national debt. So here's total Chinese reserves, so excluding gold. So the total reserves in China, in the People's Bank of China, and you can see that all through the 2000s, even earlier, this is a linear chart, not logarithmic. When I select logarithmic on the Federal Reserve's website, it really messes up the side scale, and it doesn't show you. It says that it's like 29 billion instead of 4 trillion in currency reserves. And a large portion of that, a very large portion, is US dollars. It used to be 80%. It has shrunk recently from 80%. But you can also see that they're liquidating some of their reserves. And then this is the year-over-year change, percent change. And what you see is that from the early 90s, where they had close to 80% expansion of year-over-year of accumulating reserves. And that went from the early 90s all the way until 2014, and now it's going negative. And if the president is successful, this will go a lot more negative because they won't be buying any U.S. treasuries from us, meaning they're not loaning us any currency because trade has gone back into balance. And that would be good over the long term if we had responsible government where we weren't spending like drunken sailors all the time. Politicians always promising us more free stuff. And then some of the side effects is China has slapped on their own, retaliatory trade restrictions, and they're buying, this is U.S. soybean exports. And on that top graph there, the blue area is China, and the gray area is everybody else. And so China was by far the largest buyer of soybeans. And so the soybean farmers are really getting killed. Now, I want to direct you to a movie, and then there's an article here. Here's the article I was talking about. One country is winning the trade war. It's not the U.S. and it's not China. And what happens is both countries are going to be worse off because of the trade war. However, places like Vietnam, where they've got very cheap labor, a lot of the jobs will be moving out of China to places like Vietnam. So inexpensive goods will still come in. They will still have labor rates that are far less expensive than us. But that is the conclusion from the article, that the winner is Vietnam between this trade war between the U.S. and China. And then lastly, please take a look at this video on Trump's trade war that was on HBO. It's very, very good. But it talks about the total job losses that are projected. And it's close to 500,000 jobs here. So thank you very much for listening. If you got anything from this video, please like it, share it, give it that thumbs up, click that little subscription bell, and we'll see you next time.
GoldSilver.com. Price match guarantee. Free shipping. Global storage options. Phenomenal customer service. Get the best-selling book, Guide to Investing in Gold and Silver, for free at GoldSilver.com.